Welcome back to Real Estate Mindset and happy Tuesday. Good morning to you guys. Welcome to this morning's live. We got a lot to cover today. And, let me start by saying what an absolute crazy world and time that we live in right now. Obviously, on one hand, we see headlines right now that are telling us that, home prices have hit new records. So again, headlines showing the housing market's doing great, new records were hit. Yet on the other hand, these same people refuse to talk about metro areas, as well as a lot of other people, metro areas like Austin that are currently down 18% right now from peak. And that's in the face of lower inventory than they had last year. In fact, if we look at Phoenix is down 37% with active inventory, yet it's down from peak in prices 7.8%. So even though Phoenix, for example, has massive inventory shortage, again, 37% inventory shortage year over year, the lack of inventory was not enough to prop up the Phoenix market. Again, you guys, down 7.8%. So again, absolutely insane time that we're in right now. I understand different markets, right? Different things are happening, but this is still in the fourth or fifth inning, you guys. Credit card debt, auto loan debt, right now, the defaults higher than pre-pandemic. Both, again, auto loans and credit cards. And not only that, you guys, what happens in 2 months? School loans start. I think 40 million Americans start paying school loans. I mean, you guys, this is crazy to me. And here's the thing. We have also yield curve inversion. And not only do we have that yield curve inversion, we have all of this, all of these price declines, all of these headlines, the good, the bad. I want you to remember this, okay, is in the face of historically low unemployment. What happens, you guys, if unemployment, say, goes up 2%? What happens to all of this house of cards? It's going to come crashing down. At least that's in my opinion. Now, I shouldn't be surprised. Okay. Now, I know some people are listening, some people are not listening, and I know I shouldn't be surprised. Most people, especially if you're a millennial, have never went through anything like this, yet they want to be experts, and that's okay. And the thing is, guys, I don't think we need to own houses to be smart. Right. I think that we can predict things even if we had a troubled past. Like me, I had a bankruptcy, foreclosure, and repo. I already went through this, and there's going to be absolutely no one that bullies me and tells me, Travis, don't be cautious. Home prices are just going to go up. Absolutely no one. And here's the thing. If I'm wrong, I'm okay with that because I'm going to continue increasing my purchasing power and moving towards my goals. The thing is, guys, and here's why I say I shouldn't be surprised, okay? It does bother me. Like, I don't understand why some people aren't getting this, right? There's still some people like, no, my market's busy. Everything's okay. Well, look at the big picture. Look at the big picture and also understand this is the fourth inning. Oh my gosh, you guys, insane. So again, I shouldn't be surprised because look back at the last great financial collapse. People were saying everything was okay mid 2008 during the collapse. And one of those people, y'all, was me. All right. I just want to be clear about that. I got caught up in the last financial collapse and I didn't have to, but I did. And one of the biggest reasons that I got caught up in that last financial collapse, you guys, and I'm just trying to be, completely transparent here, is I kept my head in the sand. I was like, you know what? Everything's going to be okay. I just got to work harder. Things are going to be fine. And I believe it was as a result of people keeping their heads in the sand last time. I think it led to a bigger financial crisis. I think it led to more foreclosures than were necessary. And I'm very terrified, you guys, that something like that is happening right now. Now, I understand there's some people that are purchasing the right way. Perhaps you got to have, if you're finding a house, you guys have to love it. I mean, that's literally, if you're buying houses right now, that's all you got. It's so difficult right now, you guys, to find a property with wedge and with cash flow. All you got is your emotion. So unless you're in love with the house, what else do you have right now? It blows my mind, y'all, that I've been doing this for 2 decades. I've literally got out of the business because I'm afraid for consumers right now. I'm not making any money. I'm not filtering any of my viewers back to lead generation. I have no filters. I have nothing set up to make money off of you. I'm sitting here talking about caution. I'm sitting here saying, you guys, I got rolled up in this last time. Foreclosure, bankruptcy, or repo. My credit's bomb now. I have a house. Everything is good. I'm pre-qualified, 800 credit score. And yet still, people harass me for being cautious. I'm just really at an awe, you guys. Sometimes it hits me. I wasn't even going to make this video today, but we had massive movement with interest rates, so I wanted to go over interest rates. But I'm just sitting here thinking, all of these narratives to continue to try to get you guys to buy is so disgusting. Literally everyone knows right now is a horrible time to buy, and yet there's still realtors saying go buy an overvalued house. It's okay if I've literally seen videos on YouTube saying it's okay if you lost money on your house. It's okay. The reality is it's not okay if you lose your job. All of this is happening, again, historically low unemployment. And here's the thing, you guys, I will happily say I was wrong, but this is what we need. We need to be in recession. We're not even in recession. How are people celebrating? The Fed is still raising interest rates. How are people still celebrating? So here's the thing, guys. If I say I'm wrong, guess what that means? I get to sell real estate again. If I'm wrong and I come out and say I'm wrong, I get to sell real estate again. So if I'm wrong, I'm wrong. It's cool. But the thing is, man, you guys, we're in the fourth inning here. How are people celebrating? I mean, it just really just drives me crazy, the lack of caution out in the market. I'm sorry, guys, that was a little bit of a rant. Let me just say good morning real quick. We'll get started. I really apologize. But good morning, sir. You're the first person here. We got our man Deuster. This man right here, you guys, was the first comment champion back in the day. Melissa is studying to take her license. You guys, I got you, Melissa, on the fee. Florida Beach Bum, good morning. I'm going to get through this quickly, you guys. Good morning to you. Good morning, everyone. Sacred, definitely appreciate you guys. AJ's in the house, Mike's in the house, got Johnny trying to make me nervous successfully. House Hacker here, I am blessed. Jeff is also here. Love you guys, Voval as well. I'm gonna just get going. But y'all, I'm not trying to preach. I know that there are people that are purchasing real estate right now. They're happy, they can afford it, they can ride it out potentially for 10 years. They're going to be okay. But my thing is I want to be at least the voice of reason and at least the voice of caution, because that's exactly what's needed right now. And I didn't have that myself last time, again, in 2008, 2009. So where I want to start, you guys, again, I'm sorry. I'm trying to be, really on point here, but really what I want to do is, and I'm going to go into the headlines here in a minute, you guys, and show you where we now are seeing headlines where we have reached new record high home prices. But I also want to point out that, again, and we all know this, and we see this all the time, different metro areas, different reactions. I saw Jeff commenting earlier, like it's going to hit luxury or hit more unaffordable houses first, but affordable housing is okay. The thing is, guys, just real quick on affordable housing, that's what happened last time. Okay, first of all, it always starts with luxury in houses that are expensive and trickles down. And last time during the great financial collapse, when we had more inventory, we had way more inventory, I understand that, but it trickled down to affordable housing. Depending on the metro area, even affordable housing, what's that even? It's not going to escape, right? And maybe some metro areas will, maybe some will. But overall, a lot of people still don't understand the full devastation that is coming. And I'm saying that, guys, with proof. I'm saying that with historical precedent. The inversion of the yields, for one, no student loans, GDP. Look at the unemployment info. It doesn't seem real to me. But anyways, I'm sorry, you guys. I'm going to go back into this article. So I just wanted to point out the Bay Area in California. No one's talking about the Bay Area in California. In fact, there's YouTubers in the Bay Area in California saying that everything's okay when in their own cities, their own backyards, and I'm talking investors, I won't use their name, but there are plenty of YouTubers in California. Why aren't they talking about this massive price decline going on in the Bay Area right now? And this is a May over May comparison, but look at these declines, you guys. Look at Alameda, 16%. Okay, this is year over year. This isn't even from peak. Y'all, this is not from peak. This is just year over year, May to May. Again, 11%, 9.3%. Look at Napa, 15%. San Francisco, 17.9%. I mean, the writing is on the wall here, you guys. Do you guys agree with me on this? I mean, how is the writing not on the wall? I mean, and again, if we look at the comments with people that are saying buy real estate, I mean, it's all emotional. There's very little proof. There's very little data. The caution is in the wind, and I understand why. It's the media narrative, and it's basically people have this warped idea of home ownership. And again, listen to what I'm saying. Okay. Some people, it's okay to buy right now. To those people, props, dig in, have a great time. Those are people that are well off, no consumer debt. They're going to live in their house for 10 years and they love their house and they're okay, even if they lose their job. All right. But ask yourself this question: how many people are really buying real estate like that? As someone that's a professional in the industry, I could tell you that most people are maxing out their qualifications and emotionally purchasing real estate. Most people are doing that. Not all people, but most people are doing that. Here's where we're sitting, guys. Now, this is the 10-year. We had some crazy fluctuations this morning. We actually hit a new high. So we hit a new high this morning for the 10-year. The 10-year tracks 30-year fixed rate mortgages. So on one hand, Black Knight, which is crazy, we'll go into this in a minute. Black Knight actually released the report ahead. And I've been following Black Knight for 2 years. This is the first time I remember them releasing their housing market report ahead of schedule. And the reason they did that, guys, and I'll show you real quick, is because they wanted to brag how there's a whole bunch of new records. Right? But I'm like, y'all, that's June. We're in the middle of August. We already knew this. But when we look at median sales price, it didn't reach a new record. It got close, but it did not reach a new record. I'm just saying there's so much lagging data. There is so much lagging data right now. But anyways, I want to be your trusted source of information for real estate. And I also want you guys to know, again, remember, I'm not funneling anything to me to make money off of you. In fact, I'm making so much less money by being cautious and walking this journey with you guys. I'm okay with doing that. I just want you to remember that, because it's a real thing. It's actions speak louder than words. And I believe in everything that I'm saying, just so you guys know, with all of my heart and with all of my soul. So it drives me crazy, the lack of caution. But anyways, here's the 10-year. This is down. This was actually up. I believe it got up to about 4 basis points this morning. So within the last 30 minutes, it actually went down. So a little bit of activity. But I wanted to point out that this was actually a new high. I believe we exceeded. Yes, we did exceed our last, October high. So October, I think it was October 20. You guys can see here, the 10-year was sitting at a close of 4.2%. So we hit, I think this morning, 4.23%. We hit that this morning. So the 10-year hit a new peak this morning. Pretty interesting, right? So, when I first look at this, you guys, what I'm wondering is why did we wait till after home buying season before the 10-year went up, right? Why couldn't we have just held the 10-year at 4%, around March? And the answer to that question is ultimately those bank runs. If it wasn't for those bank runs, I really believe we would have been able to hold this pattern. But as a result of those bank runs, we were not able to. And as a result of that as well, it messed up the trajectory and timelines of recession and reset or bust, right? We have booms and we have busts. They just pushed out the timeline. So the jury's still out on Jerome. Some people think it was smart of him to do that. Let me show you guys where mortgage rates are at. So we have a new 1-year high. We have the highest mortgage rates for this year, sitting at 7.24%. And again, understand, you guys, that's with great credit. Probably, I think it's 25% down. I'm not 100% sure, but we're at 7.25%. Again, you guys, that is a new record for 2023. Again, sadly, I wish, look at, and here's what I'm telling you guys right here. Look at, so here's where the bank runs happen. So right, as the bank runs were starting to happen, rates were at 7%. Right when the bank run started happening, you guys, we had a celebration on my channel. I had a 1-year anniversary. I remember my 1-year anniversary, we hit 7% right here. You see that. And instead of staying at 7% like we needed, rates went down. And when rates went down, right at almost 5%, we almost hit 5%. When rates go down like this, right in the front of home buying season, it's going to mess things up. And that's exactly what we saw here. But don't fret. We're still super high right now. Now, the record is, the 21-year record is all the way back here at 7.32%. So we're not at the record since quantitative tightening, but we're extremely close to a new all-time record of quantitative tightening. But we do have our 1-year record. I thought that was interesting. So what I'm going to do now, you guys, is I'm going to get into our first video from a former Dallas Fed. And this is a good one, you guys. This is basically a former Dallas Fed president basically saying he doesn't think that the Fed is going to do anything in September. So the market and the Fed aren't talking, right? Or in a disagreement per se. So on one hand, the Fed, Jerome Powell, saying, higher rates for longer. We're going to do, well, he didn't specifically necessarily say this, but we're going to do 2 rate cuts this year. But the market's like, nah, Fed, we run you. You don't run us. The market's like, we're going to fight the Fed. We control things, not you, Federal Reserve, not you, Jerome Powell. I mean, my gosh, you guys, how many lessons are we seeing here? Don't fight the Fed. What else are we hearing? This time's different. What else are we hearing? Soft landing. This happens every single recession. Every single recession this happens. All right, but anyways, guys, let's play our first video. Let me get the timestamp here. I'm feeling in one of those moods today, you guys. I just feel outworked. I feel outworked. I'm burnt out. I need some R&R. I won't lie. I'm just trying to stay on top of this for you guys. But here's our first video. And if you can, Johnny, you guys down in the comment section, I appreciate you being here, House Hacker, everyone, I see you. Let me know if the audio is okay, all right? But let's get our first video on the way right now from the former Fed.
Goldman Sachs is out with a new call expecting the Federal Reserve to start cutting rates sometime in the second quarter of next year after one final hike in November. Joining us now to talk more about that, former Dallas Fed President Robert Kaplan. It's kind of perfect because you're both a former Fed guy and a former Goldman guy. Welcome. Good morning.
Good to be with you, Kelly.
So the cutting is not, we haven't talked a lot about it, but it's already priced into the market, really. We had those comments from John Williams a couple weeks ago to the New York Times where he said, we might have to cut so that we don't end up passively tightening. So talk to me a little bit about what the path you think is most likely, especially since we were just talking about, long-term bond yields and worries about which direction they're going to go, that sort of thing.
Well, there's no question to me that inflation is softening, but you have a number of cross currents, as you and I have talked about before. Goods are very weak. China being so weak makes goods disinflation even more pronounced. On the other hand, you've got substantial amounts of project-based government spending. The service sector continues to be resilient and inflation is sticky there. And you also have oil prices, inching up. And so we've got a number of cross currents to get through. I don't think the Fed will take any action in the September meeting, but I think an estimate that by middle of next year, they'll feel that it's appropriate to cut rates isn't unreasonable. I don't know if it'll turn out that way, but that's as good as expectation as any, I think, at this point.
Are you worried about headline inflation picking up again on the back of oil prices or just labor market or whatnot?
If it were not for the government spending that we're executing right now, I would not be terribly worried about that, and I would think that inflation would continue to trend down. But we continue to announce new multi-billion-dollar manufacturing plant projects, public-private partnerships, infrastructure projects, unspent ARPA money.
And real quick, guys, government spending, like all these projects, that's a huge reason why, obviously, GDP showed an increase. Just FYI, let's keep going.
And that's the X factor that's hard for me to gauge. And that's the reason why I think if I were at the Fed, I'd be on my toes to see how these cross currents are going to unfold. But I think you got enough weakness and weakening in the U.S. economy that I'd still be hopeful that we're continuing to make progress on inflation.
Yeah, I mean, sort of kind of put that differently, we have one hand fighting against the other. So we have a lot of fiscal stimulus still hitting the economy at the same time the Fed's trying to tighten. Is it all going to be Goldilocks and work out just fine?
Well, so this is where I think the attention is going to shift. It's all been at the Fed funds rate and the front end of the curve. You can see in the markets, attention is now shifting to the back end of the curve, the 5-year, the 10-year, the 30-year. And there's a price for this amount of government debt to GDP, historic deficits, expected historic deficits, current fiscal spending, and that is the 10-year is backing up. And I think the story may be over the next 6 months, the backup in the longer end of the curve, that is further tightening. It hurts business, makes the bank situation a little more difficult to the extent they own long-term assets. So there's a price to pay for staying out of recession. I'm afraid it's probably higher rates for 5 and 10-year and 30-year bonds and higher deficits for the extended future. And that's concerning.
Yep.
So Robert, in 2, 3, 4, 5, 10 years, can you honestly make the case that some of these things will end up being deflationary or disinflationary? Will the infrastructure bill actually be deflationary? Will chips, will the IRA, which was called the Inflation Reduction Act? A lot of people laughed at that, but do you think down the road, long term, you can make the case and connect the dots to this actually being deflationary or budget friendly?
If they improve productivity, then yes. In the near term, my own view is there's spiking demand for goods, services, and labor. I think one of the things I'm very aware of in the energy transition, who's the leader in the world? China. China is producing more electric vehicles than the United States. They're a leader in wind and solar. And so we've got a bit of deglobalization going on in chips, in the energy transition. These are very expensive transitions. Yeah. I mean, very expensive globally.
Isn't China also leading? It's also leading in coal. I mean, you got to power the grid. They don't care how they power it.
Well, so this is what worries me in the near term, and I've mentioned it before. This energy transition is going to take 20, 25 years. We're probably 5 years away, in my view, from peak oil demand. I know nobody wants to say that, but it's true. Yeah. And if we don't invest more in fossil fuel production in the United States, we will burn more coal globally. We'll have higher oil prices, and I think inflation will be stickier and rates will be higher.
You know, Bob,
and so that's something I would like to see, a more integrated energy transition.
You didn't say yes, it will be deflationary. You said if productivity improves.
Right.
So it's not a slam dunk. Do you think that productivity will improve and therefore it will be deflationary, or that you don't know?
Listen, I'm a business person, and so I know I've been involved in a lot of capital investments I thought would have one effect, and the world changed. And so I'm hopeful, and I know the theory behind these investments is they'll improve productivity, and I'm hopeful they will, and I think it's a reasonable theory. But on the other hand, there's a view that globalization and not doing everything ourselves, and I know some other economists have made speeches recently that if we limit globalization in the energy transition, it'll make it more expensive. And I'm very aware of that issue.
All right, guys. So let me know what you think. Comment below. He said a lot there. And again, that's an important person. That's a former Dallas Fed. Some of the things that I was paying attention to on that was, and real quick, you guys, the comments that I'm throwing up on the screen is, I'm going to address those at the end of the video. Some pretty good comments there, and I appreciate you guys throwing up comments. Keep throwing up your comments. I don't care if you don't agree or you want to troll or whatever. We're all a community. Please comment. But one of the things that I really kind of honed in on what he was saying is the long end of the curve, of the yield curve, right? So 5-year, 10-year, treasury. So basically what he's saying, what I heard is over the course of the next 6 months, as a result of many things like government spending and things of that nature, the 10-year is probably going to keep going up. So, it's possible that hopefully in the next couple months here, rates actually hit 8%. Think about it. Well, 8% with people with great credit and a 20% down payment. Rates are already 8% right now for some people. Now, again, guys, all of this is happening. All of this optimism you guys see with the bulls is in the face of this historical precedence of this yield curve inversion. Let me actually switch this because I don't like using StreamYard when I share my screen. All right. So again, everyone knows. Okay, this is the 2 and the 10. This is the yield curve inversion. Here's our historical precedent. Here's the thing in our corner that's saying, Travis, you're right. Don't care about the haters. Don't care about the people that are too young to understand what happened last time. This is all you need to be paying attention to, because this means that things are not normal, and this means that things are not okay. You guys understand? So let me show you guys where we're at. Let me zoom in on the 1 year. So the depth of the invert, it got a little bit more depth of inversion, but the interesting thing is, guys, and I'm going to explain why this happened. Okay, so what you've noticed here is the depth of this inversion since about July has been going up. It really started going up at the end of July. Do y'all see that here? And what I'm talking about is that depth of inversion. Now, a lot of people are saying this has to reinvert before the pain even starts. So normally this has to reinvert before we even feel the pain. But what I want to point out is the reason why this is like uninverted a little bit here is because the 10-year has gone up. That's why. So the 10-year going up is actually causing this inversion to like the depth to decrease. So it's going to be very interesting to see that. Again, when I max this out, you guys, just to be clear, all of the last recessions we reinverted, but when we get to the inflation recessions, which is right here on the left here, when we get to the inflation recessions, and that's what we have now. Remember, this is federally induced. The reason why we have this problem is the Fed and the government. Okay, it's not, it's not like the subprime collapse, the last recession, but in the last, inflationary recessions, we actually stayed inverted. So you see this here? Look at, specifically the 1980s. Here's what I want to point out. Not only did we stay inverted when we hit recession, we were in recession for a period of a few months before it reinverted. And then the crazy thing is this, look at this, guys. So it reinverted while we were in recession and then inverted again. Do you see this? It inverted again during the recession. So what this is saying here is, like, to me, when I look at this, is when we have an economic crisis, okay, when there's something bad going on in the economy, when we throw in inflation out of control, like stagflation in the mix, the data's all over the place. You kind of got to throw the rule book out. And I think that's a problem with a lot of people. A lot of people are dismissing the economic turmoil that we're going through right now because they're just saying it's not like 2008. Because the reality is it's not like this what's going on right now is nothing like 2008. I can name you guys all the differences of right now and 2008, but I'm going to save my time. We already know subprime collapse. Okay, so people couldn't afford them. Let's say that a different way. Okay, what was a subprime collapse? It was people not paying their mortgages. Essentially, when they adjusted, we'll just say they adjusted, right? That's why they couldn't afford it. But ultimately, it led to defaults and foreclosures because people couldn't pay their mortgages anymore. So regardless whether or not we have good loans right now, which it is helpful, don't get me wrong, if unemployment gets unhinged, it don't matter if you're well positioned, you guys. It doesn't matter if you purchased a home with wedge necessarily. It doesn't matter if you have a low interest rate because you can no longer afford your mortgage payment. So just be cautious, okay? I don't want to scare people. I don't want people to think that like it has to crash and that's the only way I'm thinking. No, I'm basing what I'm telling you guys on data and on experience, and I've taken my financial bias out of the equation. I'm literally walking through this with you. I don't own a house. I'm not living in a house that I own, okay? I'm not living in a house that I own. I hate it. So again, on one hand, we see headlines where inflation is under control, inflation is going down, but look at the 5-year break-even inflation rate. This is something that the Fed is paying attention to. This is up again. You guys, it's at 2.29. This needs to go. If you guys want to know like another thing that will indicate when the Fed is going to cut rates, it's this form right here. As crazy as this sounds, this is what you watch. Like, when is the Fed going to cut rates? We'll look at the CME Fed watch, but this break-even needs to be under 2. It needs to be under 2. It's at 2.29 and it had jumped up. Look at it. Look at the trajectory. Okay. And if we don't look at the ups and downs and we just look at the bottoms, just look at the bottoms, right? Look at the bottoms of this. You can see the trajectory is headed up. See that, you guys? That's crazy because this is indicating it's okay to tighten more. This is indicating that inflation is not under control. This is indicating raise that 10-year up, baby. Let's get rates to 8%. That's what that's indicating. Really interesting if you think about it. Now let's get into our second video now. I'm going to put our timestamp on our second video. You guys, I really appreciate your time. I'm really looking forward to taking a break. I really need a break right now. So I met with my wife over the weekend. I'm going to pull up this video real quick. This next video, you guys, is on the housing market. Basically, moves will be decided by what causes mortgage rates to decline. So this is like what's left of the bulls in the housing market. They're like, the mortgage rates are going to decline any day now. And mortgage rates are going to decline any day now. So we'll look at this. But I wanted to tell you guys, again, my wife and I, got together and I had to tell her, I was like, listen, I've been working like a madman for 2 years. Like, I have literally barely even taken a break. Monday through Sunday, you guys. And I had to say, like, I don't know if I can keep going. I don't know if I could keep working like this. I can't. You guys, I'm going to be 40 this year. I'm not a young man anymore where I have infinite amount of energy. So the thing is I feel okay with taking a step back a little bit because look at what I've been doing for 2 years as I've sat out in this rental right here. I've been saving my money. I've paid off all of my debt. I have 6 months of reserve. My credit score is 800. I'm an expert in my market. I'm pre-qualified. So I think it's time. I think I might take a knee. I think I might take a knee a little bit, take a deep breath of fresh air and just remember why I love life. Remember why I'm working so hard. And also remember like, hey, it's okay that I'm not living in a house I own right now. That's okay. It doesn't make me a bad person because I'm going to tell you something, what I learned about myself when I was in the gutter, when I lost everything. What I learned is when I set a goal, I'm going to achieve it. So I don't care. To be honest with you guys, I do care. I've told you why I think what I think, but even if the housing market doesn't crash significantly, I'm still going to get a house of my dreams. And I promise you that I will still get a house of my dreams because my goals are solid and so is my determination. And that's what I'm trying to like show you guys and help you guys. Like if you're struggling, like Vital's struggling, right? Some people are struggling. My God, you guys, set your goals. Set your goals and let your goals shape your approach, right? And your goal should be save more money, increase purchasing power, increase credit, right? Understanding the whole local market. You guys feeling me? I'm not looking at the comment section, but are y'all feeling me? Can y'all tell me you're feeling me? Can you guys put an F? Can you put an F in the comment for feeling me? If you understand what I'm saying. So I know you guys are paying attention. I don't even know if you guys are paying attention. I'm probably talking to myself, but if you are paying attention, put an F because you feel me, but don't put anything if you don't feel me, okay? But if you guys are, let me know because to be honest with you, man, it is lonely and I want to know that I'm helping you guys. It's so important to me that I know that I'm helping you guys. Did you guys hear what he just said? This guy's, he messed up. He just said velvet handcuffs. You guys, this guy is kinky. It's golden handcuffs. It's not velvet. Let's rewind that. I want you guys to hear his velvet handcuffs, okay? Listen to this guy one more time. Okay, so he is saying that demand feels super high, right? Did you guys agree with me? He just said that. And people have a high demand for new homes. And let me explain one more time about new construction. Now, first of all, I've heard people say that, oh, new homes are only accounting for 1% of the total listings. That's 100% false. And understand what I've been saying this whole time. Everything is local. Everything is localized. In my local housing market in Conroe, over 50% of the listings are new constructions. In Katy, in my local area here, over 40% of the listings are new homes. So I think it's worth understanding what's going on with new homes, especially if you're in a metro area like I am that is surrounded by new homes. But here's the thing, you guys. Here's why demand appears to be up with new homes. Lennar right now, okay, let's just take what's happening right now, is offering a 4.25%. They're offering a 4.25% fixed rate plus $10,000 back in closing costs. You guys, they're literally getting people into their houses with probably only the 3.5% down. They're probably paying all the closing costs and they're giving them a 4.25% interest rate. I mean, you guys, they're offering, this is one thing I got really right about my forecasting because I haven't got everything right. I've got some right. One of the things I got really right was absolutely incredible buying incentives. But we want prices to go down, but I'm talking buying incentives. Buying incentives right now with new home builders is absolutely shocking. But also what's shocking is how many people can actually afford it. Pretty crazy to me. But I mean, it's easier to afford it when your rate is 3% lower than what everyone else is getting. Would you guys agree with that? Now, he's basically saying, the market is going to depend on why rates are cut, right? So what has to happen for rates to cut is, again, you guys, let's go into the CME FedWatch tool. But here's what I'm saying. As long as we don't want rates to be cut until June or July, because if we don't have rate cuts till June or July, we will be through the home buying season. And again, remember, I'm talking to you guys talking about the housing market. We have to talk about all this other boring stuff because the housing market has a lot of factors involved, right? The housing market affects the economy affects the housing market, the job market affects the housing market. There's a lot of things that affect the housing market. So what we really need is we really got to hope and pray here that we can maintain this level of rates because again, probably in 6 months, they're going to go even higher within 6 months. If we make it to June or July, I think we're going to be golden. I think we're going to be absolutely golden because that means rate cuts won't happen until towards the end of peak home buying season. We don't want the rates to go down right in front of home buying season like what happened this year. Remember, rates almost hit 5%. Right in the front of buying season, y'all. That made it really, really. And why did that happen? The bank runs. Geez, no one saw that coming. I didn't see those bank runs coming. But take a look at the market. Here's CME Fed Watch, y'all. No rate hike according to the market in September. Let's see if they've changed their. Oh, they changed. Look at this. Wow. So in one day, the market has repriced in a 32% likelihood of a rate hike in November. And this is interesting. This is new. Look at this. This is great. You guys, do you think this is because of that 5-year break-even inflation chart? Do you guys think this is because of that 5-year break-even inflation chart? I think it might be. But look at, they're now not pricing in, I'm sorry, but they're anticipating a 50 basis point rate hike. I don't know if that's going to happen, but they're saying a 50 basis point rate hike, 3% possibility. That wasn't here before. I'm just letting you guys know that. I wonder if we're in stagflation, and I wonder if that's going to lead to a depression. I don't know. Maybe. Let's look at December. December, less likelihood, but again, they're pricing. Look at that 50 basis point hike. Dang, that is crazy, you guys. Let's look at what they're saying in January. January, basically, what? This is crazy. So they're saying, okay, this is crazy. So it's got room to maneuver here. But here's what just happened in January. The market's saying there's a higher likelihood that in January, 52% chance, that's the middle one here, that rates stay where they're at right now. But there's an equal chance that, again, we're just talking about from right here, an equal chance that rates actually go up a quarter basis point as they go down a quarter basis point. So right here is the market saying, we don't know what's going to happen. That's the market saying, we don't know what's going to happen. There's a higher likelihood they stay the same, but in almost an equal likelihood of an increase or a cut. Interesting. I guess the market doesn't have it right. Let's look at March. This is where we don't want our rate cut, depending on a black swan. Okay, if there's a black swan, unemployment hits 5%, 6%, it's unhinged, everyone's freaking, maybe cut rates in March, but I'm going to tell you guys point blank right now, we need to start this recession to curve next year's seasonality. We definitely need to do that. We missed that this year. We cannot miss that next year. If we miss that next year, it's I just don't even want to think about it. But look at same thing here. Now here's March. They're saying 35% chance of cut. Let's look at May, more importantly. 38, so higher likelihood of a cut in May. I think we'll be better off in May, you guys. I really do. But let's look at June. Oh, interesting. So June is 30-30 on a 25 to 50. So and this is where we want to make it. We want to make it to June or July, to be honest with you guys. I don't know if we can. The economy to me appears so weak and toxic. I don't know if we can even make it that far. Oh my God. Plus, guess what's next year? The election. But this is crazy. They're basically saying June, 12% chance to hold rates. So this is holding rates right here from where they're at right now. 30% chance of 25 basis point cut, 33% chance of 50 basis point cut. So there's a heavy possibility that June is when the round of rate cuts begin. Very interesting to me. Let's move on to another thing. Now, I'm going to tell you guys, we're going to go into the record-breaking equity growth right now. Now, again, remember what we watch. We watch generally. First of all, I got my hands to the pulse of this house market, so I'm watching many different data sets. One of the data sets that we watch is the 4-week rolling average of median sales price. By watching that, because it updates every single week, usually it allows us to stay ahead of almost every single data set by sometimes months ahead. So, according to the rolling average, we didn't break record. We missed the record according to the 4-week rolling average by, I think it was by about $4,000. So we almost hit it, but we didn't hit it. But there are other ways to calculate value. Median sales price is just an indicator. Remember, I'm always telling you guys that. And remember, I showed you how appraisal value works on one of my lives. I could do it again. But remember, Black Knight, just like Zillow, just like CoreLogic, has its own way, in Case Shiller as well, has its own way to determine value. So we're just going to look at them. And I'm going to point out this. Again, for the first time since I've been following them, I've followed them for about 2 years. They are ahead on this report. They are so excited because Black Knight, y'all, I'm going to tell you right now, they're incredibly bullish. I'm actually shocked how bullish Black Knight is. But here's what it says. Home prices hit new record highs in 60% of major markets as annual growth rate rises, boosting home owner equity levels. But I also want to point out this, you guys. Okay, they're talking about June. We're in the middle of August right now. If I wanted to know what was going on in June, I'll just reverse the space-time continuum and go into the 4-week rolling average and review Redfin. This is a month and a half old. So all the people that you see celebrating, oh, new record highs, the housing market crashes canceled, blah, 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 they're a month and a half behind. The data that they're reviewing is June data. Just FYI on that. We have more data right now. Maybe I'm beating a dead horse here. I will move forward. But this is basically saying the Black Knight Home Price Index hit an all-time high in June, this time on both seasonally adjusted and unadjusted levels, with nearly every major metro area experiencing month-over-month growth. And I'm going to show you guys the values. And I'm going to show you which metro areas are losing money again or losing equity again. Prices have now reached new peaks, so new records is what we're talking about, in 30 of the 50 largest metro areas, excuse me, with several northeastern metros currently 5 to 8% above 2022 highs, okay? So everyone's celebrating, but let me show you guys a little bit what's going on here exactly. Now I'm going to do another video on this, you guys, because it's going to go into the foreclosure information, but I want to show you a couple pieces of key data here. Oh, you know what? I'll show you guys the foreclosure a little bit. So yes, the foreclosures are historically low. Okay, they're historically low. They're super low right now, but look at the trajectory. Okay, and I'm not talking about default rates. I'm talking about actual foreclosures. It's peaked up. It's like quadrupled. But what did it quadruple off of? Foreclosure bans. So we can't really compare this, right? The only thing we can really compare is the trajectory at this point, because the entire thing was reset. The entire foreclosure process and people in default was reset. But again, we can see the trajectory right here shooting up, but it's still very low. And again, remember what is very interesting, what tracks foreclosures. Do you guys remember, if you remember, comment below, what tracks closely with defaults? It's a crazy data set. It's like the 10-year treasury and the 30-year mortgages tracking each other. What tracks defaults, you guys? Let me know if you remember. I've told you this answer. You guys should know. It almost tracks exactly unemployment. Unemployment almost matches the delinquency rate. It's really shocking. So again, if unemployment goes to 4, 5, 6%, odds are defaults are also going to go to 4, 5, 6%. Just FYI, okay? Because that tracks very, very closely. Let me go down here. I want to show you guys this. Here's the spread above my picture. This is the spread for the 30-year mortgage to the 10-year treasury. This is what I just was talking about. But what I want to show you guys is what's very, very intriguing. The spread it's actually adverse right now, which means the mortgage rates have kind of formed a tiny little bit of independence per se. I'm just trying to create analogies here, but basically they have gone off on their own. So what I'm trying to point out is and again, this is only June data this is through July 20th, this chart right here. But I just wanted to point out that 10-year dropped and the 30-year mortgage rates went up. Okay. Interesting, right? That's probably an indication of the banking sector suffering and not making money. Do you see what I'm saying? So again, if the banks want to make more money, they got to raise rates higher. So that would make sense that it's not tracking the 10 years, actually going up higher. I believe, again, the reason is they're putting profit there. Let me show you guys. This is insane. Okay, now I'm tired of hearing, oh, I went to 4th grade class and I understand the laws of supply and inventory. You guys, I'm making a video after this and I'm going to go into the law of supply and demand. And I'm going to show you guys that the law of supply and demand right now is in our favor of a reset. So if you just want to stay stuck in the law of supplies and demand, I'm going to have a video. I hope to release it tonight where I'm going to go in exactly the laws of supply and demand. I'm so sick of hearing it. There's so much in play here. One of the major things in play here, okay, and I'm continuously telling you guys this, and I know you guys have great points, and I do agree with a lot of it. We need more inventory. We do need more inventory, but right now the price crashing is not a result of increased inventory. The price crashing right now is a result of equity run-up and unaffordability. Those are the two main factors at price decline, not inventory. Do y'all hear me on this? It is so far. I'm just saying, so far, it's not inventory. So what happens when we have inventory, right? But anyways, look at the unaffordability. This is insane. We're sitting at 36.4%. And let me read the disclaimer so you guys really understand what I'm trying to say here. So even though this is saying the national payment to income ratio is 36.4%. This number is false. They're using a scenario that's not reality. And I believe they're doing that to just like calm everyone down, right? And let me read exactly what this is made of, okay? The national payment to income ratio is the share of median income needed to make the monthly payment of principal and interest on an average home at 20% down. And I'm going to tell you right now, the average person puts 18% down, not 20% down. And everyone, except if you're a disabled veteran and certain other things, pays taxes, and pretty much everyone pays insurance. So this is wrong. Why aren't they adding things that they know almost everyone pays? So in other words, you guys, it's not 36.4%. It's higher than that, probably a lot higher than that, and definitely higher than the last great financial collapse. What I'm saying is things are more unaffordable now than the great financial collapse. Think about what I'm saying. Now look at this. Let's go to the income. Let's go to the value stuff. This is what I find very, very interesting. Okay, here's the decline here. This is the great financial collapse decline. You guys see we started right here with decline and then it rebounded. Same thing happened right here. You guys can see in 2006. You see, this is what I'm always preaching to people about. Let me show you guys. So let's use Black Knight's value system so I can show you this. First of all, here's the thing. A lot of bulls have been saying these price declines have been the result of seasonality. And I'm saying you guys are crazy. It's not a result of seasonality. The Federal Reserve is like hiking rates. Like, how are people missing this? And I'm also saying, like, in 2006, home values went down. We can see that right here. So home values went down in 2006, and here's the rebound. Granted, the rebound was not like the rebound right now. The rebound right now is beast. I'm not saying it's not. It's an absolute beast of a rebound. But look at after this rebound right here, massive price decline. And then, oh, we're okay. Look at this slight rebound. And then psych, horrible decline again. Do y'all see that? So it got psyched. So for as much as this went down, it went up. Same thing right here. You see that? For as much as we lost in home values now, it went up. Just like, and it's different economy, I know that, but just like in 2006, all I'm saying, you guys, is we are definitely not out of, risk right now, not even close. If we were, I'd be living in a house right now. Let me show you guys a couple other things. I'll have this linked here if you guys want to reference this. This is really cool data. They also have a mortgage monitor that's really cool that tells you like interest rates and down payments and stuff like that. Here's the month over month change in HPI. Again, this is for June. We're in the middle of August, so this is lagging data, but I wanted to point out that, remember, I think it was in April, I think it was April, nothing was down. Okay, this is month over month change. Nothing was down in April, and then May came, and only one metro area was down in May, which was Austin. Now we have June, now we have basically two metro areas that are down, one that's sideways, and a lot of additional growth has slowed down. So, just want to point out, this is peak home buying season that we're seeing this in. So peak home buying season, isn't it crazy? Texas, though? Texas was usually resilient to recessions, but it's actually showing that it's not resilient during this turmoil. Let me show you guys one other thing here. Okay, here's from Peak. Here, let me tell you guys something, okay? Overall, again, the housing market is different, but overall, if the housing market rebounded, then we wouldn't see any of this in blue. If the housing market rebounded, nothing would be in blue. But the reality is the housing market has, has recovered, I believe, temporarily in some metro areas. But now that we're like past that home buying season, all of these metro areas in blue right here that are already down, I'm telling you, they're gonna have a new low. So they're gonna beat February of this year. I think it was February of this year we hit our low. We're gonna beat that low because they're already starting down. Do y'all see this right here? So let's see, number one, Austin, 13.6% down. I said 15% is a crash. If I go to Redfin, it's down 18%, but Redfin is more updated. Followed by San Francisco. San Francisco is showing 8.8% decline from peak. But when I go into August, you guys want to know how much San Francisco is down? Let me see. I have it written right here because I'm actually took some notes on a separate video. It's bad, man. 15.2%. San Francisco's down. Phoenix down 8.4%. And let's end with Phoenix. Okay, and then I'll go into the comments. I want to show you guys Phoenix because I heard this video. I won't use any names. People are like, oh, the crash was supposed to happen in Phoenix. You guys were all wrong. Inventory is down 34%. You guys were so wrong. But let me show you guys something. I find this extremely, extremely interesting. Okay, let me show you guys what's happening in Phoenix. Let me show you the inventory in Phoenix. I want to show you the active inventory. It's insane. It's insane. Let me find it real quick. I'm in Redfin right now. Active listings. Here we go. I'm going to go for Phoenix. I'm going to show you guys. You guys are going to be blown away. And here's why the supply and demand, only the supply and demand theory, it just does not work. Because we have price decline and we don't have inventory growth. Okay, take a look at Phoenix. Okay. This is like a case in point. You guys, Phoenix right now is down 37% in inventory right now. But I will also say that a couple months ago, it was actually up 4%. Okay, so only 2 months later, it's down 37%. So obviously this data is all over the place. But nevertheless, let's look at this data. It is all over the place. Phoenix is down, meaning like, oh my God, the inventory is gone, right? 37%. So home values should have shot straight up, right? That means that demand is there and the people are buying houses, correct? Inventory is down 37%. What do the rules of supply and demand tell us, you guys? Prices should be going up now, right? Price should be going up. Let's see what the prices are doing. Let's go to median sales price, okay? Oh, wait a minute. Phoenix isn't even on the year-over-year positive list. Phoenix right now, you guys, is down 4% year over year. Phoenix is down from peak about 7%. So even though they have, listen to what I'm saying, even though they have 37% less active listings, they still cannot get above that year over year positive list. In fact, they're down 4% and from peak almost double digits. And guess what? We're going into fall and summer. This blue line, I'm going to tell you guys right now, in Phoenix, it's going to be under the black and the orange line. It's going to be under the black and the orange line. Hopefully it'll be way under, obviously, because look at this run up. This run up in equity is that orange line right here. This run up in equity was a monster in Phoenix. And that's really the problem here. It's this run up. That's what I'm saying in Phoenix. This run up is not going to sustain. People can't afford to sustain it. But again, you guys, active inventory in Phoenix is down 30 some percent. You guys, you know what? I don't feel like you're sold. I haven't looked at the comments. I got to show you another one. Okay. I'm going to show you guys another one. And I wanted to save this for my video this evening, but I just want to show you guys this because I think we need to talk about it right now. I'm going to pull up. This one is a beast right here, you guys. You're going to freak. Because again, I'm showing you guys this because the laws of supply and demand. It's like y'all, if people are only going to talk about the laws of supply and demand, like your comprehension is at a third grade level. It's a third grade level comprehension. We got to ask ourselves, what affects laws of supply and demand? We don't just say, oh, laws of supply and demand, it's in a vacuum. It's always going to be this way. No, it's not always going to be. There's factors, right? I'm going to show you San Francisco. You guys are going to freak out. All right, so San Francisco is down 23%. And this is active listings, you guys. Listen to what I'm saying. San Francisco is down 23% in active listings. Okay, so if they're down 23% in active listings, if we just talk about law of supply and demand, then the prices should have rebounded, right? The prices in San Francisco should be shooting straight up. Why? Because the supply, the inventory is straight down. Well, it's not straight down, but it's a 0.25% down. That's a lot, right? Is that a lot? Maybe, maybe not. Let's look at the prices. Again, prices should be up because inventory is down 23%. Let's look at median sales price. Oh, whoops. Actually, prices are down. You guys hear me on this? So again, please, you guys, absorb what I have just told you. If you're stuck on law of supplies and demand, if you're stuck on, the inventory, which is important, but expand your mind to like more stuff going on. Like, for example, the Fed, just equate the Fed alone, just the Fed. You guys, 24% down, okay? And prices have been plummeting since what? Middle of June? Look at this. Plummeting. It's going straight down. And there's 24% less inventory and it's straight down. In fact, San Francisco's down 6% year over year. But if you guys want to know what San Francisco's down from 2021, it's down even more. You guys, San Francisco's on the year over year over year price decline list. In fact, from peak right here, from peak to here, okay, just from peak to here, 15%. Again, active inventory down 24%. And again, all I'm saying, you guys, and I really hope you guys are getting this, but all I'm saying is there's just more involved. There's more going on right now. And, quite frankly, a lot of people don't know what's going to happen next. And, I think the caution is warranted. Let me show you guys this. I think I already showed you the inversion. Boom, 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 boom. I want to show you this. I want you guys to remember something very, very important. Okay, if you don't agree with me or you want to argue with me, even though I've went through all of this, I'm trying to be cautious. I'm not financially biased. If you want to disagree with me and hassle me, please understand everything that I just showed you is with historically low unemployment. Every single thing we talked about is before a recession has started. It is in the face of a 3.5% unemployment rate. Okay. So again, I'm just saying, my point is this is a house of cards. I think caution is a must right now. I think that for some people, it's okay to buy. For some people, it is okay to buy. So go buy. But again, if you're buying right now, there's basically 4 things, okay, that if I was buying right now, this is what I would be doing. There's 4 things if you're buying right now, because I know that there's some people going to buy no matter what. Maybe they think they have to buy, whatever the reason is. The number one thing is you got to comfortably afford it, okay? Number one, comfortably afford it. Number 2, have a 10 to 15 year hold, right? So you're going to hold it for 10 to 15 years. Number 3, make sure you love it. And number 4, purchase if possible like an investor. If you're going to buy your primary residence, I know even if you don't want to invest it, I know it's just a roof over your head, you guys. I'm not trying to be some greedy, unethical person. I am just saying, please listen to me. I've lost everything already. Right now, especially important, if you're buying your primary, do it like an investor, guys. You got to do it like an investor. There's so many reasons. I can spout off many reasons, but you got to buy with wedge, preferably, and with cash flow, okay? And wedge for just the sheer reason, if you have wedge, like if you purchase a home for undervalue and prices go down, odds are you could still refinance. But if you purchase a house and it's at market value and prices go down, you're locked out. So again, wedge, or purchase a property with equity. So let me pull up some of these start questions real quick, you guys. Really appreciate each and every one of you from the bottom of my heart. Oh my gosh, I am long-winded today. We're going to pull up this and we're going to get out of here. Okay, so I'm going to start with AJ. AJ is basically saying, unfortunately, the saying, a sucker is born every minute is true. Otherwise, we wouldn't have boom and bust. I mean, come on, guys, listen to what he's saying, right? Not everything is a headline. Not everything is great news here. If everything was great news, then the Federal Reserve wouldn't be involved. Right? Jerome Powell wouldn't be meeting with Congress right now. We wouldn't have bank runs. We wouldn't need that $400 billion bailout in March if everything was okay. Here's Scrog. I need to hurry. I'm about 1 to 2 weeks from listing my home. Here's the thing, Scrog. You don't need to hurry. In fact, you need to not hurry. But if it comes to selling your house, I will say, yes, you probably should hurry, just depending on your situation. But I also want you to understand, Scrog, like what I did, you don't have to buy a house right away. Absolutely no one. Well, okay, let me take that back. I know realtors and investors are saying buy, but Scrog, you don't have to buy right now. You can do exactly what I'm doing. You can rent, you can empower yourself, increase your purchasing power, make sure the area that you want to live in is everything that you want. No one is saying that you have to buy right now just because you sold your house. You can go rent. You can literally go rent. Learn how to be humble again. Learn how to live below your means again. Learn how to be happy not having everything you want. Right? I mean, it is pretty amazing. And I credit a lot of my mental transition to my ice baths. Here's from Don't Move to Texas. Michael Berry shorted the S&P in the tune of 1.3 billion yesterday. Okay. So if you guys want to know who Michael Berry is he's the man that no one believed, like during the last financial collapse. He shorted the market and said the whole market is going to collapse. Okay. So he just made a $1.3 billion bet that the housing market's that the market is going to collapse, specifically the stock market. And if we look at really what are we missing from now, in the Great Depression, it's 2 things, unemployment and an additional stock market crash. Very interesting. But I thought you guys would find that intriguing. He actually made a huge bet. I want the market to slow down around here, as it is really difficult to get electricians because they're so busy with new construction. So I just throwing this comment up to remind you guys, some areas have a tremendous amount of new construction. If you're in those areas, consider yourself lucky. I am, but some areas do not have any. Here's a comment from House Hacker. It's going to get harder for first home buyers in San Diego because Amazon, Google, and Apple are expanding. So I would say that it's possible, right? When we get through the recession and turmoil, but I would say it's going to be harder for the first time home buyers right now because ain't no one ready for what's coming. And I would also say that because the prices are like House Hacker, how the heck are these kids going to afford to live in I mean, if think about it, House Hacker, if you're a local in San Diego, what's the median sales price? It's like 900,000, right? Ain't no one can afford to live in San Diego if they're a local there. It's migration. You're dealing with migration and wealthy parents in San Diego. That's what you're dealing with. You ain't dealing with first-time homebuyers in San Diego, not normal first-time homebuyers in San Diego. San Diego is in a world of hurt. I'm very intrigued. On one hand, San Diego has no listings, like existing, almost no listings, but yet they're still on the year-over-year price decline list. Another metro where we can tell that it's not just inventory that matters, but also from House Hacker, we also know that in those markets, there's possibilities to find a great deal. And that's why I keep telling you guys, hunt, okay? All right, you guys, I think I'm going to I got a super chat here and I'm going to get out of here. I'm a little late today. So this is Jack Was Approved for $200,000. He was pre-qualified for a $200,000 mortgage. He makes $54,000 in salary income. And then they've calculated $6,000 in self-employment income, and he has $320,000 in cash. He considered a $340,000 loan in Wheatfield, New York, 750 credit. Can I email you? So yeah, I mean, tell me what you want emailed, brother. And I think I saw a comment there. Someone was talking about a comment for income. Let me throw this up here, Jack. So self-employment income, if it goes from $6,000 to $30,000, that does make a difference. But you have to remember when self-employment income is calculated, you have to average 2 years. So just because it's going from 6 to 30 does not mean you get the full 30. You get 6 plus 30 divided by 2. Do you see what I'm saying? Because it's 2 years. They got to take the 6,000 and the 30,000 and divide that. So what is that? 36 divided by 2. What is that? Like 17,000, 18,000 or something? Was it 17? I don't know. But the thing is, I don't know if you should be buying in New York, man. I mean, you can email me, Jack, but unless you're going to email me a property that you can show me a wedge and you can show me cash flow and you're saying, Travis, I absolutely love this house, you already know what my answer is going to be, my friend. You already know. Okay. All right, you guys, I definitely appreciate the super chat, brother. I'm going to get out of here. You guys have a great day today. I hope you're letting your goals shape your approach. I hope you're proud of yourself for your discipline. And other than that, guys, if you're out there investing in real estate, I wish you luck and I hope you win. Thank you.